Hi, Doug Andrew here. In this episode, you are going to be able to answer the question, why is money that grows inside an insurance policy, and specifically a max-funded indexed universal life insurance policy, tax-free? Because sometimes people say, well, that sounds too good to be true. You need to be able to answer that question. So at the end of this episode, you're going to understand why it's sort of a sacred cow in the Internal Revenue Code for over a century. You're going to learn about sections 72E, 7702, and 101A, and you should know those by heart. This will set you up for the next episode where we talk about 3 tax citations, TEFRA, DEFRA, and TAMRA, but we need to understand the basics first before you understand how these relate to those 3 sections of the code. Now, you're going to also understand that these 3 sections of the code are what allows money inside of an insurance policy, the cash value, to accumulate tax-free, allow you to access that money tax-free before you die for living benefits, which is what we're trying to do for most maximum funded indexed universal life policies. And then 101A is the one that allows for the tax-free transfer upon death. And when you understand the dynamics between these 3 sections of the code and the history behind how E.F. Hutton sort of came up with this idea of universal life to be used for living benefits, as it relates to compliance with these 3 sections of the code, you'll be ready to understand these 3 tax citations that most CPAs and tax attorneys get stumped. They come and their mouths are open because they've never understood this stuff before. And unfortunately, what you're going to learn here, they do not test you on to get your insurance license. I think that's a shame. So as you watch and learn, I want you to be able to answer questions. How does the IRS allow you to accumulate, access, and transfer your money totally income tax free? That sounds too good to be true. Well, no, it's been around long before IRAs, 401ks, any of those that are just tax deferred type of concepts. And you'll understand that investments are usually taxed sooner or later, and they're usually subject to market volatility, and I don't want that. So I don't want my insurance contract to be deemed an investment. In fact, it's not an investment, and accordingly should not be purchased as an investment, and I'll give you the history behind that rule. So as we proceed, get ready to understand the basics of these 3 sections of the Internal Revenue Code, and you'll hopefully understand how to make this a tax-free cash cow for your clients. So let's start with the basics. When the Internal Revenue Code came about, or taxes came to stay, that was, I think, in 1913. Prior to that, the only time that the federal government taxed Americans was to finance wars. So taxes, income tax, for example, would come and go. But in 1913, it came to stay. So it's been around for over 100 years. Now, ever since then, life insurance has always been this sacred cow. Why? Because when people are trying to be responsible and accountable and make sure that they are taking care of their family in the event of an untimely death, or to make sure that if they have money for retirement, they're not a drain on society. In other words, if you take control of your finances, if you take pressure off of the government providing welfare benefits or the needs in retirement that a lot of social programs do, if you'll take responsibility for that and take pressure off of the government to do that, guess what? They will allow your money in that vehicle to accumulate tax-free. It's not some loophole. They know exactly what they're doing. It benefits them. It saves them money to let you accumulate money tax-free and access it tax-free when you're preventing or avoiding your widow if you pass away. The orphans you leave behind from having to be a drain on society and social dollars. So that's basically why it's tax-free. You're taking pressure off of the government. You're doing more for this country than rolling over and paying more and more in unnecessary tax. So that's why it's sort of been a sacred cow. As we go through this, in the Internal Revenue Code, Section 72E basically says that money that grows inside of an insurance policy, the equity, we call it cash value, where we're way overpaying for the actual COI, the cost of insurance. That sits in the insurance policy to accumulate. And they say, we'll let you accumulate that money from the insurance company's interest or dividends, however you do it. See, whole life usually pays dividends. You have interest-sensitive whole life. Universal life is usually credited with an interest rate, or it's linked to an index, as you're going to learn. And they're saying, however your cash value is growing, that will be non-taxable. That's tax-free. That's under Section 72E of the Internal Revenue Code. It allows you to accumulate your cash value tax-free. Now, if you're going to use the universal life policy for living benefits, for tax-free income, that if you put in $500,000 like many of my clients did back in 1980, and you want to start taking out $50,000 a year instantly, your interest, they were earning, remember, 11 netting 10 in that example. That means $50,000 a year. If you want that income to be tax-free, you want the IRS to know you're getting it. I mean, the IRS knows everything. But you want it to be cut and dried. No, this is tax-free. Then you need to adhere to Section 7702, and you have to do it the right way. You're going to learn in the next episode, there's 3 ways to access money out of an insurance contract. There's the sad way, there is the dumb way, and there's the smart way. So when we talk about accessing money, you have to do it in compliance with that section right there if you're still alive. Now, when you die, it's one heck of a return, but I wouldn't recommend this method. But when you die, Section 101A provides that the death benefit, if I put in $500,000 and the death benefit is $1 million, that $1 million transfers tax-free to my beneficiaries. So that is a tax-free transfer, and it usually blossoms in value, but it's totally income tax-free. Now, it could be subject to estate tax, depending upon the estate tax rules and limits and so forth at the given time. We're talking about income tax here. The income tax-free transfer is provided under Section 101A. So remember, 72E, you accumulate tax-free. 7702, you can access your money tax-free. 101A, when you die, it blossoms and transfers income tax-free. Nothing else in the Internal Revenue Code does that. And when you learn that dynamic concept and the advantages of tax-free accumulation, access, and transferability, it's magic when you design the policy to benefit your client for living benefits. So as we look at this, I want you to understand that life insurance designed this way is protected under the Internal Revenue Code under these sections. Now, if you violate the definition of insurance by moving out of the definition in these 3 sections of the code, you put in more money than the GSP that you learned about, the guideline single premium. The insurance company either has to refund the money you paid in more than you were allowed, or it moves out of these 3 sections of the code over to taxable investment part of the code. So when the financial services industry, some advisors get jealous and the law firms come out and people get sued and so forth, and they go, hey, wait a minute, life insurance is for death, not for, you shouldn't call it an investment. I would roll my eyes and go, really? You can call your college education an investment. Most people call their home an investment. You put money into your home, it's an investment. But do you know in the financial services industry, you legally cannot call your house an investment? You cannot call an insurance policy an investment. Now, I'm okay with that. I've learned to adapt and roll my eyes, but let me just explain it simply. Again, if you do not keep it under this definition of tax-free insurance, it moves over to an investment in the Internal Revenue Code, which is subject to tax. I don't want it to be taxed. So I'm okay with it not being called an investment. And investments are normally subject to market volatility. They don't have predictable rates of return. So if that's what an investment is, I don't want an investment. In fact, life insurance policies are not investments under that definition, and accordingly should not be purchased as an investment. It's an insurance contract. What would you call something that you put money into and it grows at an incredible, great, predictable average rate of return between 7 and 10%, and it's totally tax-free, meaning it doubles your money every 7 to 10 years based on the rule of 72. That if you put in $125,000 in a lump sum, it will double to $250,000 in 7.2 years. That will double to $500,000 in another 7.2 years. And it will double to $1 million in another 7.2 years. In 30 years, it's worth $2 million, and then $4 million, then $8 million. I actually have clients who started out with $500,000. It doubled to $1 million, $2 million, $4 million, $8 million, and that $8 million is generating 10% payouts of $800,000 a year of tax-free income without depleting principal. And when you ultimately die, it increases in value, blossoms, and transfers totally income tax-free. Now, that was a long question. What would you call something that did that? When I ask audiences, the first thing they say, a miracle, a dream solution, a godsend in this topsy-turvy, unpredictable world. Yep, but you can't call it an investment. The financial services industry won't let you do that. I'm fine with that because investments are usually subject to market volatility, and they're going to be taxed when you take it out most of the time, if it's a traditional IRA or 401k especially. And so I want you to understand from this episode that this is such an incredible instrument, the dream solution for so many financial goals that pass the liquidity test, the safety test, and rate of return test with flying colors, and it's tax-free to boot. And you're going to learn about that LASER, LSRR, that's the acronym LASER, liquidity, safety, rate of return, and then the tax benefits. This is liquid asset safely earning returns, which is the acronym LASER. It's the title of my book, The LASER Fund. And under 72E, 7702, and 101A, it's the only vehicle that I'm aware of that allows you to accumulate that money tax-free, to be able to access that money tax-free for any reason at any time without IRS penalties. And when you ultimately die, because none of us are getting out of here alive. I don't mean out of this room that you're watching this in, right? I mean out of this life. We're all going to die someday. And when that happens, this blossoms. I'm 68 right now. If I died right now, this afternoon, this evening, in an automobile accident, every million I would have in an indexed universal life insurance policy would blossom at my age right now to about $2.5 million instantly and transfer tax-free under Section 101A. You show me a Roth that'll do that? Doesn't exist. There's no other vehicle that does that. And then people say, well, how much does that cost? I say, well, it doesn't cost me anything. Nothing's free, but I'm not paying for it. It's being paid for with a minuscule portion of interest that would otherwise go out the window if I had my money in a traditional investment in an IRA or 401k subject to market volatility. Again, I'd have to be earning 15%, pay tax, fees to net 9 or 10. I only have to earn 11% in the index universal life to net 10, which I've been doing for the last 25 years. I've actually averaged 11.17. I've netted 10.07% cash on cash rate of return. That 1% is money that would otherwise go out the window in taxes. So Uncle Sam pays for my insurance. And the way I look at it, it's being paid for with otherwise payable tax. We don't object to insurance benefits. We object to paying for them. I've never had a widow or a widower turn down an insurance check. Oh, here's $1 million. I am so sorry for the death of your partner. Oh no, I don't want it. No, I've never had one turn down an insurance check. We don't object to the benefits. We object to paying for it. If I could get Uncle Sam otherwise payable tax to pay for the insurance, let me put it this way. If you were an employee and I came and said, hey, we're having a banner year. We have some additional benefits for all the employees here this year. We're going to provide some free life insurance. How much would you like? Now, predictably, guess what people say? As much as I can get? Yeah. We don't object to the benefit, we object to paying for it. If it's free, we'll take as much as we can get. Well, is it really free? No, but I'm not paying for it. It's being paid for with a minuscule portion of interest that would otherwise go out the window in taxes if I chose to put my money in investments. So rather than do that, I put it into a max-funded insurance contract, and it turns into this cash cow that has been grandfathered in the Internal Revenue Code for over a century. So hopefully you're getting it. Put on your seatbelt. The next episode is going to talk about these 3 tax citations that we have to sort of jump through those hoops to keep it tax-free forever.